clearly the 10-year government bond yield, as you know, bottomed out around 115 basis points. It's back up to about 130 today. And that has a real positive effect on the steepening of the yield curve, which, of course, is beneficial to the banks. But I think the market is also determining that, as you heard today in Jackson Hole from Chairman Powell, there's a very high likelihood that tapering could begin by the end of the year. And of course, if they start cutting back on their bond purchases, there is a likelihood that the yield curve could steepen even further, which would be positive for the banks. So I think the move that you've recently seen in the banks is reflective of both rates moving up already, but also the anticipation they could go even higher over the next 12 to 18 months.
Not all banks are created equally, of course, as we alluded to in the intro here. It's those that are making loans, and that's the bulk of their business, that are potentially poised to benefit here. But there are also, investment banks and other types of financials out there. Do you believe that those that are kind of the bigger lending-focused firms that are the ones that are poised to benefit, or are there others that could also benefit in ways that may not be as obvious?
I think what we're going to see, Leslie, is a rising tide lifts all ships. So many, if not all of the banks will benefit from a stronger economy in this steeper yield curve should it start to materialize further over the next 3 to 6 months. But there are some banks that could benefit even further. And when you look at the asset sensitivity of the balance sheets of the banks, and asset sensitivity is essentially the assets repriced faster than your funding costs, primarily deposits. And some banks are more positioned to benefit from the steeper curve. And more importantly, when the Fed decides to raise the short end of the curve, which of course is Fed fund rates, they'll do even better. So names like a Bank America, a Wells Fargo, and then the custody banks, especially names like Bank of New York and State Street, would all benefit very nicely should this yield curve steepen and we start to see higher short-term interest rates, possibly as soon as the second half of 2022.
How important are dividends and buybacks to what we're seeing so far in the market with regard to banks? Just recently this summer, the Fed, after a pandemic-induced hiatus, allowed firms to return capital to shareholders through buybacks and dividends in a way that was no longer capped. Do you think that this is an important calculus as investors are looking ahead in terms of investing in banks right now?
I think it is, because when you look at the industry, it's overcapitalized. Following the financial crisis, as you know, the capital ratios for the industry were changed dramatically. Banks were forced to raise capital. They've been extremely profitable for the 10 years following the financial crisis, and they built up enormous levels of capital. And to your point, the Fed did temporarily suspend buybacks during the pandemic. They lifted that suspension on July 1st. So when investors look at banks, this is definitely one of the pieces that they use to determine when they should buy bank stocks. And we fully believe that the return of excess capital, or the capital action plans, which includes dividend increases and buybacks, will continue indefinitely into the future, because again, the banks are very profitable, and on top of that, they have excess levels of capital.